Hey guys, it's Eddie here from Deline Property. Today I want to do a quick video, and this video is all about pre-tax versus post-tax. And this is about when you're holding an investment property for investment property purposes to make money. There's a few different terminologies and different aspects which I'm going to explain today. And one of them, so we've got the first one, which we'll jump right into it basically, is pre-tax cash flow. And then on the other hand, we've also got post-tax cash flow. So I'm going to explain the differences between the two, and some key factors, some very important information on how I grew my property portfolio to 15 properties at 27, the age I'm at now. So there's a lot of different strategies out there on how to invest in property, and there's a lot of different ways on which you can make money by investing in property. And I've grown my property portfolio over time by buying properties that are below market value, that have a really good strong rental return, that are in metro areas that can go up in value as well. So this video is mainly looking at the cash flow side of things. So we'll jump right into it. We'll go into pre-tax. So what basically pre-tax cash flow is when you're buying an investment property. And when people hear the term cash flow pre-tax is basically broken down on the board, and we'll go through it. Hopefully the writing's not too small and you can actually read it. But say for example, for this scenario, I've got two different examples on the board. For this scenario, we bought a property for $250,000. and it rents out for $350 per week. Now there's some great examples on our YouTube channel that you can check out, and you can actually check out the types of properties where they're at. Bear in mind, this is within metro areas. So bought a property for $250,000, it rents out for $350 per week. The cash flow on this property, $350 per week, we're using annually, so the income, $350 times 52 weeks in a year is $18,200 roughly. So that's your income from holding that $250,000 property. This side right here, however, is the expenses. So this is the expenses per annum, and I hope you can read it, but basically repayments roughly, whether you do them on interest only or principal and interest can vary, but it's up to you. So repayments per annum per year is $10,000 to hold that property. Then you've got council rates. Now bear in mind, these figures can change, and these are just rough figures that I put on the board, which are similar to some of the properties that I bought for myself and for clients. So don't jump on and do comments of, oh, this is going to be a little bit more here, a little bit more there, but this is just averaged out, okay? So just take it with a grain of salt. So council rates for this property, roughly $1,500 per year, so 1.5K. Water rates and all that other kind of stuff to hold the property, $1,000. Management fees, where you pay a property manager to manage it, etc., $1,000. Insurance, whether it's building insurance, landlord insurance, etc., or if it's different types of other expenses which can come up, like maintenance, strata, and all the rest of it. So $1,000. So these are just rough figures, as I said. So holding costs, basically, to hold this property here is $15,000. So that's the holding cost to hold this property, and the income on holding the property is $18,200. So you basically take this over here, you minus that, and that's where your property looks like pre-tax. So pre-tax, you're in front $2,700, which is pretty good. So the property rents out $350,000, and the properties you bought it for $250,000. So that's about a 7 to 8% rental yield, which is pretty good. Those are the ones I buy every single day of the week. On the other hand, other side of the spectrum, we've got this property right here, and property is double the amount. So we bought it for purchase price $500,000. The rent on this property is a little bit less, because let's just say this is a Melbourne property or a Sydney property, and this is a Brisbane property as an example. So it's $500,000, the rent is $400 per week, which per annum, that equals to $20,000, $800 per year in income, total income holding the property. Then same as the other side, we've got the repayments on holding this, so about $20,000 mortgage repayments, council rates 1.5, water 1.5, could be a little bit more, a little bit less, but say, bear in mind the management fees in the water would be a little bit more because it's a more expensive property, so the management fees especially. So 1.5, insurance, $1,000, etc., $1,000. So rough figures as I said, but the rough holding cost for this property is $26,500 in expenses. So it's essentially negative geared property. The income was $20,800 per year in income. You can break this down weekly, monthly, whatever it is, just divided by 12 months or 52 weeks in a year if you prefer to calculate it weekly or monthly. But basically 20,000 income, 26,500 expenses. So what are you left with? You're minus $5,700 per year. Now, this is where a lot of other people will contradict this, and they'll basically say, yes, it's a negative geared property, but this was a nice brand new property, or it could be existing, but you get to get tax deductions, you get to get depreciation, and bear in mind you can get depreciation on this one too, but I haven't calculated that in. But yeah, so if you buy a new property, you can depreciate it and all other kind of stuff, or if you can do depreciation and claim that off your taxable income. So post-tax, you might be able to claim back 6,000 or 7,000. So you claim back, say $7,000 as an example. That's probably a good day as well. So 7K, and then you're plus $1,300 per year, because you basically that $5,700 has reduced your income, and then if you've got depreciation and deductions and all other kind of stuff, you can you might get $7,000 back off your tax bill for losing $5,700. Best case scenario. Most of the time you only you'll get less than that back, but this is based on depreciation and all the rest of it. So those are the different areas basically. So one of the biggest questions and the differences between this point and this point over here is that, and the reason why I particularly love this one over here is because one of the biggest things is what happens if you lose your job and you're not paying any tax. What happens if, say for this example, the whole strategy with building this portfolio, purchasing this property, so, some investors buy 5 or 6 of these things and they're losing $5,000, $10,000. And if you're losing 10 grand per property and you buy 6 of them, you're losing $60,000 a year. It's the stupidest thing I've ever heard of, to claim back, a little bit here and there. So, and get your tax back. But this whole strategy is based on what? It's based on you actually working in a job, paying tax, and getting that tax money back. So if shit hits the fan and you don't work, say you're on an income of 100 grand or whatever it is, to service that loss, if you don't have that, that's where you're gonna have to put this thing up for sale right away. That's where a lot of bankruptcies come from. When expenses don't match up with the more than the income, people go get in big trouble doing that kind of stuff. So doing it this way, if you lose your job, your property is more or less looking after itself. And bear in mind, these figures, as I said 100 times, can change. But this property's positive cash flow before tax, and this one, technically, if you claim depreciation, claim all the other, other side of it, it might be positive geared after tax, but that's based on depreciation deduction, which don't last forever. Depreciation doesn't last forever. So, and you could get depreciation on this one as well, bear in mind. So it does get very technical on looking at both different sides, but basically you're losing money on this side, you're making money on this side, and if you lose your job, you can keep this one. It's going to keep going up in value forever. The rent's going to keep on increasing over the next 10, 15, 20 years. This one, if you lose your job, you're pretty much screwed. You're going to have to sell that property kind of thing, or get another job right away. So there's lots of different things can happen. So I hope this video has helped. If you do have any questions, please send them through. I hope it's maybe opened up your mind a little bit. to look at the individual expenses on either side. We have here at Deline Property a Deline Property cash flow sheet, and you can actually, it's an Excel spreadsheet which is very in-depth, very thorough on how you can calculate your cash flow pre-tax. And if you would like to get access to that, send us a message or email us, and we'll be more than happy to send that through to you as a free gift from us to you. So hope this video has helped. Thanks again for watching, guys, and I'll catch you in the next video. Bye.